off the road. Okay, good evening to all of you. Welcome to our class. And last time we met, we were discussing on how we do get cost of capital, okay, in cases, how we get the marginal cost of capital. Okay, that is, I think, where we did stop last time, okay. Now, our next topic, before we go to our next topic, okay, just to assess as to whether we are all comfortable, okay, when it comes to assessment of the marginal cost of capital, okay, I would want us to attempt some few questions, okay. Our next topic actually is on risk and return, okay. That's our next topic, on risk and return, okay. But before you do that, okay, let's attempt maybe one more question on how we do get the marginal cost of capital for a company. Okay. Last time we were doing, there's a question that we were doing, okay, which was on September 2015, okay, question 3B, okay, September 2015, question 3B, okay, I think was a pretty comprehensive question, okay, and a good one, okay, for us in understanding how the company is financed itself, okay, as well as estimation of the marginal cost of capital, okay, as well as even getting the breakpoints, okay, which I think we did mention, okay. How do we assess the breakpoints, okay? So I would want us to do a similar question, okay, where if possible, okay, we are meant to assess the cost of capital and assess the breakpoint, okay. Let me see if I can get a good question with such a case. Okay, we're meant to get the cost of capital. At the same time, we also meant to make an assessment of the company breakpoints. If you get it, you let me know. I'm trying to trace the question through the question bank. Okay, I have one here. Okay, if you check on the November 2015, okay, check on the November 2015, okay, question 1C. So November 2011, question 1C. November 2011, question 1C. Okay, go through it, then we attempt together. Okay, the exam is asking you to get cost of capital as well as to get the breakpoint. Yeah, so yeah, that's good. Okay. November 2015, question 2011, question 1C. Okay, so go through it. We attempt together. Okay, so in case you look at that question, okay, you've been asked compute the specific cost of capital, okay, for each of the financing, and then part 2, you're meant to get the cost of capital below the breakpoint. Okay, see that I still remember how to get the breakpoints. Okay, either way, let's attempt it together. Okay, how to get a breakpoint as well as how to get the cost of finance from each of the capital source. Okay. So in this case, we told the company is going to obtain the money from the following sources. Okay, we have debt, we have preferred stock, as well as we have equity. And as you can see, equity, you're going to raise money from 2 main finance sources. Okay, one of them is from the retained earnings. Okay, and the other finance is from the issue of shares. Okay, so in short, you're meant to get the cost of capital from 4 sources. Okay. So let me get my board. Okay. Okay, let me get my board here. Okay, so cost of debt. If you know that debt is going to be raised, the company can raise unlimited amount of debt. Okay, so just from that point, okay, that the amount of debt the company can raise is unlimited, which implies therefore the brake is not on the debt. Okay, so because as you see, when it comes to the raising of finance from the case of debt, okay, it's unlimited. Okay, so the cost is not going to jump up. Why? Because it is unlimited. Okay, so therefore the brake is not occurring on debt. Okay, anyway. The amount of debt the company can raise, okay, they can issue, okay, a debenture, an 8% with an 8% coupon with a par value of 1,000. The maturity is 20 years, okay, on which the interest payment will be made. Okay, to sell the issue, an average discount of that shillings per bond would be given. Okay. From having done that, okay, now we estimate the cost of debt. Okay, so you'll be here is November 2011, question 1C. Okay, so cost of debt. Okay, we can estimate the cost of debt. Okay, this bond, okay, it has a number of years to redemption, 20 years. The coupon, we be told, is equal to 8%. We be told that the issue net of the issue price, okay, the issue price net of issue cost, okay, net of issue cost is 1,000. Okay, however, it will be issued less 30. It means therefore for every bond we'll be having 970, which becomes more or less like our P note. Okay, become therefore like our P note. Then we'll be told power 1,000 coupon is 8. Okay, I think having had all that information, we can now be able to estimate what ought to be the cost of this bond. Okay, what ought to be the cost of this bond. Okay, therefore you can say RD. Okay, simply the P naught again from the known. Okay, P naught is going to be equal to the interest you'll be receiving. Okay, we discount back to year 0 times present value earned factor 20 years R% plus the redemption value, okay, times present value interest factor 20 years R%. Okay, and we see that our main objective here is estimating the R. Our main objective here is to estimate the R, the cost of this debt. Okay, to estimate the R, the cost of this debt. P note here is the interest. Do we pay tax here? Okay, yes. Okay, it is just below the capital structure. We'll be told that the company tax rate is 30%. Therefore, the net interest income or expense to company, okay, will be equal to 8% times the par value of 1,000, 1 minus T. Okay, 1 minus T. This is going to give us therefore 56 shillings to be the net amount. Okay, 56 shillings. Okay, to be every year for the next 20 years, the holder, okay, or the company cost, okay, is 56 shillings. Okay, redemption value. Okay, regarding the redemption value, okay, we assume since it is silent on the redemption value, we go back to our main assumption that the redemption occurs at the nominal value. Okay, the nominal value of 1,000. Therefore, if you remember, we say that the cost of this bond, okay, will not be too far off for the same bond, okay, if that bond was to be redeemable. Okay, so therefore, essentially, okay, the cost of the same bond or similar bond that is irredeemable, okay, would be equal to the interest we are paying. Okay, it is the interest we divide by P naught. Of course, we express as a percent. Okay, interest is 56. P naught, okay, is 9670. Okay, and of course we express this as a percent. As I say that, don't forget, you don't need to do this working. Okay, you don't need to do this working. Okay, it's just for our consumption. Okay, just to know where our cost of debt will be roughly around. Okay, so what do you get to be the RD here? Okay, and you get 5.77. Thank you, and you get 5.77% cost of the bond. So therefore, roughly we expect that the cost of this debt should be roughly around there. So 5.7. So we can begin at 6. Our trial and error method. Okay. So what if we start discounting these cash flows? Okay, we start discounting these cash flows. Okay, at now 76%. Okay, do we get the same P note? Okay, let's attempt to do that. We see what we shall get. So our first trial, okay, at 6%. Okay, this will be equal to P naught is negative, so it's equal to negative 970. The interest we're getting is 56 times present value and factor, 20 years, 6%, plus the redemption value is 1,000 times present value interest factor, 20 years are 6%. Okay, what do you get in case we're discounting the same cash flows at now 6%? We discount them at 6%. What do you get? Okay, and we get negative. Seem to be the number of answers. Not sure which is which. Okay, so negative 15, but they're all negative. Negative 15.89. Okay, so let me use that. Okay, negative 15.89 to be the sum of those cash flows in present value terms. Okay, but that was at 6%. Okay, now what if now since you're negative? Okay, I might decide to, you can use whatever it is. Okay, use 7, you can use 8, but let me use 5%. Okay, to reduce the negatives. Okay, to lower the to increase the present value. Okay, to get a higher figure. So what if we discount the same cash flows? Okay, but now at 5%. Trial and error method. Okay, so let me try the same process, but now at 5%. Let's see. At 5%, to be equal to negative 970. Okay, plus 56 times present value and its factor, 20 years, 5%. Okay, plus 1,000, the redemption value, present value interest factor, 20 years, 5%. What do we get? Same process, but now we discount the cash flows at 5%. Okay, and get 104.78. Oh, okay, and get 104. Sorry. So get 104.78. 104.78. Okay, it's a positive. With me, therefore, the cost of this debt is between 5 and 6%. Okay, it is between 5 and 6%. Therefore, RD will be equal to 5%. Okay, the difference between the two rates. Okay, 6% minus 5%. The value at 5% is 104.78. Okay, divided by 104.78 minus we got 15.89. Okay, minus 15.89. Therefore, from our IRR formula, what do we get to the cost of this debt? Okay, and we get 5.87. Okay, 5.87% to be the cost of this debt. Okay, as we mentioned, look at the cost of the same bond if it was to be redeemable. Okay, in case the question is set correctly, okay, it is not too far off from the cost of the same bond. Okay, if it was to be redeemable. Okay, and I think just refer back to our working for the cost of the same bond. Okay, if it was to be redeemable, I think we did get. Okay, we did get. Okay, we got 5.77. Okay, and as you can see, the cost of this bond is not too far off from that 5.77. Okay, so that's it helps you in eliminating multiple trials. Okay, to ensure that you can know where your answer should be. Okay, roughly where should my answer be like. Okay, that's on the cost of the debt. Okay, the cost of the debt. Okay, that's our first working. As I mentioned, the debt is unlimited. Okay, therefore we don't have a break point. Okay, or the debt doesn't introduce a break point. In short. Okay. The second finances is the preferred stock. Okay, the preferred stock. Okay, so maybe part B. Okay, same question is cost of preference shares. Okay, cost of preference shares. Just remind you, RP is equal to preferred dividend. We divide by P naught. Okay, of course we express as a percent. Okay, so therefore we need to get the preferred dividend. Okay, and we told that the preference stock we have here, they pay at 8%. Okay, and at its price, it's 95 share price per value. Okay, so you can see the per value for this particular stock is 95. Okay, therefore the preferred dividend is 8% of the nominal, that is 95. To give us how much? The preferred dividend is 8% of the nominal value, and the nominal value for this preferred stock you have seen is 95. So how much do you get with the dividend? Okay, we get some answers here. And we get 7.6. Okay, we get 7.6, therefore, to be the preferred dividend. And then we told that the cost of issuing, okay, and selling this stock is 5 shillings. Okay, therefore, the amount received net of issue cost, okay, let me just call it P note, okay, is equal to the issue price, which is 95, minus issue cost, which is 5, wants to give us 90. Okay, to give us 90. Therefore, simply you can say, therefore, the cost of the preferred dividend is the preferred dividend, 7.6. We divide by P naught, net of issue cost, okay, 90. And of course, we express as a percent to give us how much? Okay, and we get 8.44. So 8.44% become therefore the cost of these preference shares. Okay, 8.44, the cost of preference shares. Okay. Then C, okay, or the next financials, okay, we'll be told, just to make a comment, okay, we were told that the preferred stock there, the amount that can be issued is also unlimited. So therefore, the break is not being introduced by the preferred stock, because the amount that can be raised is unlimited. Okay, so the break is not coming up because of the preferred stock. Okay, so let's go to the next source. Okay, the next finance source for this company is equity. Okay, equity, and as we said, the firm expect to have 100,000 of retained earning in the coming year. Okay, so you can see the amount. There's a restriction. Okay, how much money can the company raise from retained earning? It's 100,000. So you can see now we do have a break. Okay, we do have a break. Okay, because retained earning is not unlimited. Okay, it's limited to 100,000. Okay. Then if the company don't want to issue shares, it means that they can issue share at 2, however, they shall incur a real cost of 2. Okay, I think from there we can estimate the cost of equity, okay, from retained. Okay, so C, okay, cost of equity, both for retained as well as from the issue of new shares. Okay, so cost of equity shares, not equity shares, but equity. So can have first one, the cost of retained. Okay, cost of retained earnings. Okay, as per the information given, you'll be told that the growth in dividend is 6%. Okay, and the dividend expected in the coming year is 6 shillings. Okay, from there you can know what model to use. Okay, the dividend growth model. Cost of equity is equal to the dividend. The dividend, okay, D naught 1 plus G. We divide P naught minus, in case there's cost of rotation, okay, plus G. Don't forget this is retained, okay, which implies therefore there is no flotation cost. Okay, we want to get the cost of retained, so therefore we don't have flotation cost. Okay, so be careful on that. Anyway, therefore the dividend will be told that the company expects to pay. Okay, so be careful on the terms being used. Okay, on the tenses being used in the sentence. Okay, this is like the dividend we expect. Okay, it has not yet been paid. Okay, therefore this is kind of our D1. Okay, not D naught. Okay, be careful. Okay, the D1 is equal to 6 shillings. Okay, why? Because it's what the company is expecting to pay in the next 1 year. Okay, it is not the most recent dividend. Okay, but it's what the company expects to pay. Okay, then G is equal to 6%. P naught to be told is equal to, okay, 62. So sorry, it's equal to 62. Okay, is equal to 62 shillings. Next, from there, we can now be able to estimate what should be therefore be the cost of equity. Therefore, RA is the dividend with D1, okay, D1 divided by P naught, because plus G, okay, plus G, okay, plus G, okay, which is equal to therefore D1 is equal to 6. We divide P naught 62 plus G 0.06. Okay, of course we express as a percent, and that gives therefore the cost of equity, the cost of return earning, and the part of equity. Okay, and you get how much? Okay, and you get 15.68. Okay, so you get 15.68% with the cost of retained earnings. Okay, the cost of retained earnings. The next part of equity, okay, is the issue of new shares. Okay, issue of new share. Okay, so cost of new equity share issue, new equity shares issued. Okay, so the same process. Okay, but don't forget now you're going to have the cost of flotation. Okay, so the cost of equity will be equal to D1 6 divided by 62. However, we incur flotation costs. Okay, because the company is actually issuing this cost in the market. Okay, so minus the cost of flotation, which we told is equal to 2. Okay, so minus 2 plus the G 0.06. Okay, give us how much with the cost of issuing new equity shares in the market. 16%, I guess. Okay, and I guess 16% to be the cost of issuing new shares in the market. Okay, the cost of issuing new shares in the market, 16%. Okay, here you have to I think the only thing you have to be quite careful here is that this is D, this is the you have to be cautious. Okay, that this is D1, not D not. Okay, because in case you confuse that, then of course you're going to end up with wrong answers. Okay, this is D1, not D not. Okay, D not is the most recently paid dividend. Okay, or what the company expect to pay, assuming the share is trading come dividend. Okay, I should remember that concept. Okay, if the share is come dividend, then that dividend is D not. Okay, but in this case, therefore, the share is not trading come dividend. It's what the company expect to pay in the next one financial year. Therefore, that's because of a D1, not D not. Okay, that's why you have to be quite careful in that question. Okay, I think we're done with Roman 1. Okay, getting the cost from each of the financing. Then Roman 2, determine the breakpoint, okay, and the cost of capital below the breakpoint, okay. We have mentioned, okay, that when the company is raising money from equity, okay, they can raise from two sources, either from the issue of shares or from the use of retained earning. Okay, we have just said that from the retained earning, the amount available is only equal to 100,000. Okay, the amount only available is equal to 100,000. Okay. Therefore, that's why we do have a break. Okay. Therefore, you can say therefore the break point. Okay. That is in case the company was to raise more money. Okay. Above that, then the cost is going to change. Okay. So the break point. Okay. Is equal to the maximum amount of money that the maximum amount of capital the company can raise. Okay. Before the cost changes. Okay. Now, in case the company was to raise more than 100,000. Okay. From 10 earning. And they want to raise, for example, they want to raise 150, then the 100 from returning, then the 50 will come from the issue of shares at a higher cost. Okay, but the cost from returning is 15.68. If they use equity share, the cost has increased. Okay, so what is the maximum amount of capital the company must raise before the cost changes? Okay, you just seen is equal to 100,000. What's the proportional amount of capital, okay, the company has obtained, okay, from that capital source, that is from equity. Okay, if you go back to the capital structure of this company, okay, the company has debts 30 million, stock 20 million, equity 50 million. Okay, to give a total of 100 million. Okay, therefore, what is the equity proportion in that particular in the company capital structure? It's 50 million out of 100 million. Okay, that's very simple working. You don't need to do that. You don't need to do this. Okay. So equity, okay, proportion in the capital structure, okay, on the company, optimal capital structure, okay, on the company capital structure. Okay, equity you've seen is 50 million, okay, out of 100 million, okay, because you can express as a percent to give us therefore 50% or 0.5, okay, or 0.5, okay. Therefore, going back to a breakpoint, okay, the maximum capital you can raise 100,000, we divide by the proportion of equity, which is 0.5, to give us therefore 200,000. That is a breakpoint, okay. That is a breakpoint. Okay, the breakpoint get is equal to therefore 200,000. Okay, if the company was to raise money until 200,000, okay, the cost is going to remain constant. If the company was to raise more money than 200,000, then of course the cost should have increased. So the question is, okay, what was the cost below below the 200,000? Okay, before we go above the breakpoint. Okay. So I say that you can take any, you can take 100,000, you can take 50,000, you can take 200,000, okay, provided it's not yet above the breakpoint, okay. So you can take whatever portion you want to take. Okay. For the ease of analysis, let me just take 100,000, okay, so that we just stick with the column structure we have there, okay. So if the company, okay, let's go here, the MCC, okay, marginal cost of capital, okay, below the breakpoint. Okay, below 200,000, 200 million, so 200 million, okay. So that you can take whatever whatever amount you want, provide it's below, provide it's the maximum is 2,000, okay. So let me just check, okay, for my context here, 100 million, okay. Therefore equity, okay, from that context, equity, we just remain with the company capital structure, okay, where equity will be equal to 50,000, debt remain as it is, okay. Debt remain as that is the million, and preferred stock remain at 20 million. So you just want to maintain that, okay. But you can choose whatever you prefer, okay, provided it's not yet above 20,000, okay. Which this makes 50%. You can see that this makes 30%, and for preferred stock it make 20%, okay. Okay, having done that, I think now we can go to estimate the MCC, okay. The marginal cost of capital, okay, will be equal to 0.5 came from equity and a cost of, don't forget we are not yet above 40,000, okay. So the company is raising, the company equity capital portion is purely from retained earning and cost of 15.68. Then 30% came from debt, okay, plus 0.3 came from debt at a cost equal to 5.87. And the company 20% of the capital came from preferred stock at a cost equal to, remember, let me check my working, at cost equal to 8.44, at a cost equal to 8.44, okay, times 8.44%, okay, and that will be the cost below the breakpoint of 200,000. So what do we get to the MCC therefore? Okay, and we get 11.29%, okay, 11.29% with MCC, okay. And simply is how we do get the cost, the MCC below the breakpoint, okay. Question? I really hope that everything was really clear.
I have a question.
Yes. So
for the breakpoint calculation, why did you decide on 100,000?
Oh, you can take any figure, okay, provided it's below the breakpoint. Okay, you can take 150,000, 150 million, you can take 180, you can take any figure, provided it's below the breakpoint.
No, like the 100,000, the one on top of 0.5.
Sorry, no, can I, where is that?
Why written breakpoint is equals to 100,000.
Oh, 100,000, yes.
Yeah, where did you get the 100,000?
Oh, it was given in the question. Just go back to the question. If you look at the question, okay. That question. So you've been told that if you look at the equity portion, okay, if you look at the equity portion, the firm expect to have 100, is it million or the thousand? Okay, they are within thousands. Okay, so anyway, the company expect to raise 100,000 from retained earning in the year 2012, okay? So it's 100,000, okay? It's from retained earning. Now this is it. So there are thousand actually, not in million. Anyway, the farm expect to raise 100 shillings, okay, from generally. So this came from the question given to us. So this is from the part we have been given there. Hope you can see it.
Yeah, I've seen it.
Yeah, so actually, I think we may have made a slight mistake here. Okay. Let me just hear from this is to Stacy. Kami.
I wanted to ask why we chose, while calculating MCC, why we chose cost of retained earnings instead of equity, instead of ordinary share.
Instead of the issue ordinary share capital. Okay.
Yeah.
Essentially, when it comes to the ranking of capital, okay, should we first issue shares or should we first use the retained earning? Okay, from equity, we first use retained earning. Once we exhaust retained earning, then we go to the issue of shares. Okay, but first we're going to be using the equity capital. First would have to come from the retained earning. Then once the company exhausts the amount they do have, then they can go to the market and issue capital.
Okay, and then in calculating the MCC,
yeah,
the previous calculation used to divide by the total of.
Yeah, you can do that even now. You can do that, but only the thing I have done here is that I've used the 0 0.0. Okay, in case you want to use, let me first correct something because I think we may. I don't know whether it's the examiner has a mistake or it's us we have done a mistake. But anyway, let's do a correction. Then I'll ask the question coming. So here, okay, in this question, I thought 1 million. Then actually they in 100 of shares either way. Okay. So this is the breakpoint, okay, is going to occur is 200 shares, not million, okay. I think I missed that point, okay. It is 200 shares, 200,000 shares, not million, okay. Which means therefore, okay, the breakpoint is not 200 million, okay. So it's not this. So I need to do some correction of that point, okay. It is meant to be 200, it's not million, but 200,000, okay, because that's where breakpoint is occurring, okay. 200,000, not million, okay. Then you can choose, okay, whatever amount of capital. You can choose what amount of capital, provided they are below 200,000, not above, okay, because the break is will occur, okay. So it must be below it must be at the maximum is 200,000, not above that, okay. So this actually should not be in million. This should be in thousands, okay. So I guess I need to correct that, okay. This should be. And let's say that you can take whatever amount, okay, provided it's not above 20,000, okay. So let me just use them as thousands, okay. So 150,000, 30,000, and 20,000. And here, okay, it is not in here. It is not in million, okay. It's in thousand. So let me also do that correction. But otherwise, everything else remain, okay. Now, Kami was asking, okay, why I have used 0.5, 0.3, okay, I've used 0.2 here, okay, and then the question we're using the total capital, okay, you can do also total capital, there's no difference, okay, let me just show you, okay, so the MCC, in case you want to total capital, be equal to, from equity, we got 50,000, so 50K multiplied by the cost, which is equal to 15.68, okay, plus the amount you received from debt was 30,000, okay, and the cost of debt, which is equal to 5.87%, plus the cost of equity, okay, cost of profit share, okay, 20,000 times 8.44, and we divide total capital, which is 100,000, okay, it's the same thing, because if you take here 50,000, okay, you take 50,000 divide by 100,000, it gives you 0.5. 30,000 divided by 100,000 gives you 0.3. Okay, and 20,000 divided by 100,000 it gives you 0.2. Okay, so it's the same thing. But either way, you can also use the actual values. Okay, or you can use percentages, or you can use ratios. Whatever you prefer, there's no harm. Okay, Kami, I hope I have answered your question. Michelle.
Where are we getting the 50,000, 30,000, and 20,000?
Oh, where is it coming from? Well, okay, let me answer it. Now, the company capital structure, okay, let me take you back to the company capital structure, okay. If you look at the question, okay, in the company capital structure, we have debt, you can see it, debt 30,000, preferred stock 20 million, okay, equity is 50 million. If you check percentages, the percentage for debt is 30 million out of, okay, so I have maybe a small working here. This is 30 million out of 100 million. In percent, you get 30 million, isn't it? For the preferred stock, okay, it is 20 million out of 100 million. So 20 million, okay, out of 100 million. In percent, you get 20%. And equity, it's 50 million, okay, out of 100 million. And in percent, we get 50%. Okay. Now, don't forget the total amount of money we want is 100,000. From equity, it'll be 100,000 times 0.5, and we get 50,000. From debt, it'll be 100,000 times 0.3, and we get 30,000. From preferred stock, it'll be 100,000 times 0.2, and we get 20,000. Michelle, that's clear.
Thank you.
Okay. Then someone else, Stacy, you had a question. Stacy. Stacy, you ran away. Anyway, okay. And that's how we do get the cost of the MCC, okay? Now, to finish on that topic, okay, because I think we may need to have to go to the next topic. Don't forget, in most of the time, in most exams, you have a question on the cost of capital. So I hope it's you are quite comfortable, okay, on estimate the cost, okay. Maybe a final question is one I've seen on MCC also. A final question. Then I think the others, you will be pretty comfortable in attempting any other question that can be thrown on your way by your examiner. Okay, so it's somewhere in sitting of November 2017. In November 2017, I'm not sure whether you've done it or not. I don't know. But you can tell me if you've done it, okay? So in sitting in November 2015, question 3B, have you done it? November 2017, question 3B. I'm not sure that you've done it. In case you have not done it, then I think we can attempt it. If we have, let me know. November 2017, question 3B. Sharon is asking, please expound on what a breakpoint is, okay? So breakpoint is the maximum amount of capital, okay, that you can raise before the cost changes. That's called a breakpoint, okay? The maximum amount of capital as a company we can raise before the cost changes. In short, in case we have to raise more money than that break, then the cost to the company will increase, okay? Of course, can increase or decrease, okay? But if the company was to raise more money than that, then the cost is going to increase. That's what we call a breakpoint. The maximum amount of capital the company can raise before the cost changes. Okay, if the cost is going to if the amount of capital is going to be more than that, then there'll be an increase in cost. That's what we mean by a breakpoint. Okay, I hope that's clear, Sharon. Okay, the maximum amount of capital that we must raise before the cost changes. In case we raise above that breakpoint, okay, then of course the cost to the company will be increasing. Okay. Okay, so if we suppose that you have done something in the group that you are all in, okay, just to David. David.
Yes.
Yes, you can take us through on part one.
I started by getting the proportion.
Okay, so let me have my workings. So you started by getting the proportion of what, and what?
The proportion of the capital structure, because we are being told that the project will cost 180 million.
So the project costs 180 million. Okay, sure.
80 million.
Yeah.
So we want to know the cost of equity capital, the proportion of equity capital
Yes.
that 180 million will take.
Yes.
And that one will be for 80 million plus 96 million, the return earnings, the return profit.
Yes.
Over the total 960 million times 100,
Yes.
and we got 60%.
6%. Okay, let's just pause there. So equity. We have fair ordinary share capital, okay, which is equal to 480 million.
Yes.
Okay, so for 80 million, then we have retained earnings for this company. So retained earnings of this company, which is equal to 96 million. Total to give you how much total?
Total gives me 576 million.
526 million, okay. And
Over
then
the
you have
total.
debt. You have debt, which is equal to 384.
Yeah, 384.
And total equal to 960, okay, 960 million. So therefore, the proportion of equity is how much? Proportion of equity?
That will be 60%, 576 over
506 million out of 960 million, and we express as a percent, and this gives 6%.
60%.
60%, okay, fair enough. So far, so good, okay.
So if you do the 60% of 180 million, which the project will cost?
So project cost, okay, so this is project cost. Okay, so project cost is equal to 180 million. Go ahead.
Over 60%.
So amount from equity, so equity finance required, equity finance
60% of 180 million.
will be 60% of the 180 million, okay, to give you how much?
This is 108 million.
To give you 108 million. Sure, go ahead.
And this 108 million, we are being told that the company expect to retain 80 million to finance this project.
So 18 million finance this project, that's true, that's true.
Yeah, so we'll subtract 18 million from the 108 million.
Yes. So amount from retained earning is equal to 18 million.
Yeah.
Amount from retained earnings is equal to 18 million. Okay. So equity, external finance. So equity, external finance
will be the 108 million minus 18 million, which gives you 90 million.
108 million minus 18 million to give us?
90 million.
To give us 90 million. That's very good, David. Yes, to give us, therefore, 90 million. So the amount of capital the company is going to raise from external issue shares is equal to 90 million. That's very good.
Yeah. So just to answer, Roman 2.
Okay, Roman 2. Let me ask someone else, David.
Okay. Yeah,
but you've done very well in Roman 1 and your group members. That's very good.
Thank you.
Okay. Okay, let me check someone else. That's one for Roman 1. That was quite great. Okay. Amolo, I think you came late, Amolo. So let me not ask you. Rose Nyamai. Rose. Rose. Rose Nyamai, you went underground. What happened? I think I've just unmuted you. Stacy, you have a question as Rose prepares.
I have a question.
Yes.
For the Roman 1, is it okay if you just leave it at 60% of 180 million, or do you have to break it down into retained earnings and issue of shares?
60% of 180 million. Now the question here, if you check it out, the amount to be raised from equity capital, if capital stock is to remain unchanged. Now actually, I think you don't need to break it up, because I thought actually they're asking about external, but in Roman 1, they have not mentioned about external. Yeah, for sure you can leave it at that, okay? 60% of 180 million. Yeah, you can leave it at that. Yeah.
Okay.
Yeah, but in case you're asking, just in case, the amount to be raised from external equity capital, then you have to do this. Okay, in case the question was more specific, but in this case, you can leave it at that. Yeah. Rose Nyamai, you're waiting for you. Yes, we can hear you.
Yeah, so I'm saying I joined the class a bit late.
Sorry, you did what?
Joined the class a bit late.
Oh, you joined the class a bit late.
Just when you were breaking to the question.
Well, okay, so okay, it's okay then. Let me check someone else.
Okay.
Faith Kisu.
Yes.
Yes, Faith, you can take us through Roman 2.
In my group, we've both done Roman 2.
You did what? Roman 1 and Roman 3.
We started with Roman 1.
Yes.
Then we are trying to figure out how to do Roman 3.
Oh, okay. So you haven't done Roman 1 in your group.
We have done Roman 1, but not Roman 2.
Oh, okay. Okay. Let me take another group then. Susan Junguna. Susan.
Yes.
Yes, you can take us through Roman 2.
We had not reached there.
Wow, you're not reached there. Okay. Sharon. Sharon.
Yes.
Yes.
Okay, we had also not reached there, but I think
Yes.
since we have found the amount of equity external finance, we should
Yes.
divide it to the cost for. Okay, we've been told in Roman 2 that the market price is 30 shillings and the flotation cost is 5 shillings.
Okay, so first begin. So the external equity capital required is how much?
90 million.
So the external equity capital required, I think you've changed from the previous note 1 is 90 million. Okay, go ahead.
And okay, note 2, we've been told the market price for the shares is 30 shillings.
Yes.
And the flotation cost is 5 shillings.
Yes,
so
yes.
I think
Mm-hmm.
I think you should add flotation cost.
We add, so we get how much?
35.
35. Okay. So maybe just to we stop there. We've been told that if you treat the shares in the market currently, you can issue them for 30. However, you shall be incurring some cost of 5. Should we add or subtract?
I think you should add.
Why would you want to add? Don't forget the amount of if you you have to go to the market today, okay? One share you'll be selling it for 30, isn't it?
Yeah.
However, out of the 30, 5 shillings goes towards the cost you'll be paying to the auditors, the cost you'll be paying to the lawyers, the cost you pay to the CMA. Anyway, for every share you issue, for every share, what's the amount that remains?
25. Okay, we subtract to get
you subtract,
25.
yes, because in case you add, it means you'll be getting that 5, whereas that's not the reality. You'll be getting 25 after you take care of the cost. Yes, okay. Therefore, the cash to be raised, okay, cash raised per share, okay, you can say is equal to the issue price,
25.
okay, issue price minus issue cost. Yes, that is 30 minus 5 to give us 25. Okay, go ahead.
Yeah. And then now I think you should divide it with the 90 million.
By 90 million, that's true. We divide by 90 million. Okay, don't forget capital. Okay, we say it is given us. Okay, here in this case to be the issue price net of issue price net of issue cost. Okay, we multiply by the number of shares. Okay, the number of shares. Now the question is that how many shares should we issue? Okay, okay, that's become for next working. Yeah. Okay, it will be equal to 90 million is equal to 25 times the number of shares. Okay, therefore the share price, therefore the number of shares will be 90 divided by 25. And you get how much for the rest of the class?
3.6 million.
And so do we have 25? We get 3 million?
3.6 million.
3.6 million. So you get 3.6 million. Therefore, to be the number of shares we need to issue in order for us to get the 90 million from the issue shares. Yes, that's how you're meant to have done in Roman 2. Thank you, Sharon. Okay, Roman 3. Now, I don't know whether you guys are done Roman 3 now. Let me check. Alex.
Yes.
Yes, have you done Roman 3? A bit of it.
We had not done it.
Oh, okay. But you can take us through, or you're not comfortable?
I'm not comfortable.
Okay. Mosoti.
Yes.
Yes, Mosoti. You can take us through Roman 3.
Yes.
Okay, fair enough. We'll do Roman 3 now. Okay. You're meant to get the MCC. Take us through.
Okay, so you look for the cost of capital. So we have equity and debenture.
Okay, so cost of capital from each of the sources. So we begin with
equity.
So cost of equity. Continue.
Yeah. So the cost of equity is equals to D naught 1 plus G over P naught.
So 1 plus G, we divide P naught.
Yeah, plus G.
Plus G, that's true. Okay, continue.
Okay, so I did not include the flotation cost because I was calculating for the cost of retained earnings.
Okay, so we begin with Roman 1, cost of retained earning. Okay, cost of retained earning. Okay, retained earnings. Fair enough. Continue.
Yeah, so cost of retained earnings is 5 multiplied by 1.05 divided
What is
by
5?
30.
Before we go, what is 5?
5 is the most recent dividend paid.
Which is D naught. Okay, so D naught is equal to 5. The most recently paid dividend. That's true. Okay, 5 times
1.05.
What is 0.5?
We have a dividend growth rate of 5%.
Oh, 5%, that's true. So 1.05, the G is equal to 1.05. Okay, continue.
Divided by 30.
30, what's 30?
30 is the current market price.
Oh, 30, that's true, which is P dot, okay? True, okay.
Yeah. Then plus 0.05.
Plus 0.05, which is the growth in the dividend. Therefore, to give us a cost of equity of how much?
22.5%.
22.5% to get a cost of equity equal to 22.5%. Okay, that's only for the cost of retained earnings. That's very good. Okay, continue.
Yeah, so for the rest, the second one, we now minus where you had P naught, we minus now the flotation cost.
What do you want to get?
At the cost of
issue new shares. Yes, the cost of issue, the cost of new share issue. Yeah, that's true. New share issue. Don't forget the only difference that you mentioned between the retained and the new share is simply that in the new shares, don't forget you shall be incurring the issue cost. For retained earning, there is no initial cost. Okay, that's good. They have R equal to the same limit, so 5 times 1.05. We divide by 30. So we subtract here. What did you mean, Mosoti?
Yeah, you subtract the 5.
We subtract the 5, okay, plus
0.05.
0.05. Okay, don't forget the only difference with the two, okay, is that here we shall be incurring the flotation cost. Here there is flotation cost, okay, in the issue of new shares. Okay, that's good. Continue, Mosoti.
You get 26%.
So you get 26% to the cost of issuing new shares. So far, so good. Okay, so you're done the cost of equity. What's the next bit, therefore?
Cost of debentures.
Cost of debt. Cost of debt. Okay, so cost of debt. Cost of debt. Okay. Continue.
So cost of debt is equals to the interest divided by P naught times 100.
So is a debenture? Is a debenture?
Yeah.
Is it redeemable or irredeemable?
Irredeemable.
Okay, so since the question is silent, I think we mentioned that we always assume that it is irredeemable. Okay, so RD is equal to
interest divided by P note times
Mhm.
100.
Times 100%. Okay, true. Continue.
Yeah, so you find the interest. Interest is equals to 15%.
Okay, so this debenture pays 50% times
Times the per value times 100.
times 100. True.
Yeah, times the corporate tax. You
So
say
you pay
1
tax.
minus.
So 1 minus 0.3. Okay.
Yeah,
That's good. So that'll give therefore the net interest expense to give us how much?
10.5.
Give us 10.5 shillings. Okay, that's good. So we have the interest, our numerator. P naught, our denominator. How do you get it?
Since we have a flotation cost, we have to subtract it. So you see, you take 120 minus 10, you get 110.
Okay, so cash raised per debenture. Okay, just trying to maybe have a working for it, which you don't need, but anyway, just show. So 120 minus 10, isn't it?
Yeah.
To give us how much? 110, isn't it? To give us 110.
110.
Therefore, RD is equal to the interest, which is equal to
10.5 divided by 110.
To give us 110. Okay.
Times 100.
7%. And this gives us how much?
9.55%.
9.55% become therefore the cost of this debenture. Pretty good, okay? Okay, so we have identified the cost of capital from each of those two sources. What next now?
We calculate the marginal cost of capital.
So MCC, the marginal cost of capital, will be equal to?
Okay, I've not done that part. I've done.
Oh, you done that? You have not done that part. Okay.
Yeah.
I think let me just complete that part. Okay. Thank you, Masoti.
Yeah.
Okay, so for the MCC, okay, it's simply we're trying to determine, okay, how do you raise the money, okay, the 180 million, okay, so just have here, okay, how we're going to raise the money, okay, so let me just call it the project financing, okay, project financing. Okay, we say that from equity, okay, you're going to raise the money in two ways, okay, one is new share issue, okay, which we got 90, we already done that already, okay. In million, we got 90. We said from 10 and in, it is 18 million. From 10 and in, it's equal to 18 million. And from that was the remainder. That is 40% of 180. Okay, not sure how much you get. 40%. Okay, the debt was 4%. I think we did that. The debt, since, okay, what was this? Yeah, since equity, okay, look at here, equity, we got for 60%, and of course the remainder is debt, okay, the 40%, okay, the remainder is debt 40%, okay, so 40% times the total capital required 180 million. So how much debt do we require therefore? Okay, we require 72 million. We require 72 million to give us total equal to 180 million. Okay, okay, that's good. Therefore, now I think we can get it is quite easy. Amounts that the amount that comes from what's this? I'm not sure where markings has gone. I've lost my working, but I think it is pretty easy. Okay, so anyway, I think we are getting the cost of debt. Let me just replicate what we just done. Interest, we got one of the cost was 105. Divide by 110, we express as a percent, which we got. How much is it? I can't remember. I think I lost all my working. So 10.5 minus the 110. Okay, and here 110. We said is equal to 120 minus the issue cost, it was 110. It was 9.55, 9.55. Okay, so having done that, we said we need to get the MCC. Okay, so instead the first thing to get the MCC is how do we finance the project? Okay, project financing. Okay, we say that the money will come from equity and from debt. Okay, from equity, we say to come from the ownership capital, the issue of share. These are new shares, which we got in million, okay, and it was 90 million. Then you have from the use of tyranny, which was 18 million. 18 million. Then we have from debt, the balance, okay, from the debt, we said it's 40% of the entire capital required, 180 million, to give us 22 million, a cost equal to 180 million, okay. Now to get the MCC, okay, to get the MCC, the amount we need is 180. 90 million will come from the issue of new share, and the cost of issuing new share, I think we got it somewhere. Cost of issuing shares was 20%. Okay, here we have it. Okay, 26%. Okay, so times 26% plus the amount will come from the Chinani, 18 million, and the cost of Chinani we got from marking here, 22.5% times 22.5%. Okay, plus the amount that comes from debt, 22 million, and the cost of debt we obtain is to be equal to, and here we have it here, 9.55%. We divide by total capital, which is equal to 180 million. To give us an MCC equal to how much? Okay, you get MCC equal to how much? Okay, we get 19.07%. And get 19.07% to be the MCC, okay? So simply, it's how we do the cost of capital as a topic, okay? I hope it was all clear to all of you, okay? 19.07% have become the MCC. Most often than not, okay, you will get a question from examiner, okay? It can either from getting the MCC or getting the company weighted average cost of capital, okay? So get to know the difference. Don't mix the two, okay? Otherwise, you're going to end up with the wrong answers, okay? So get to know the difference between the company current cost of capital, the WACC, and the marginal cost of capital, okay? The difference is a difference, okay? MCC is the extra cost the company shall be incurring for every extra sharing they'll be raising from the market. Okay, that's the key difference with the two. Okay, and I think having done that, I presuppose that you are all very comfortable. Okay, and you're not going to embarrass yourself in the exam room if a question comes in. Okay, it's pretty easy. Okay, I don't think there's nothing, okay? It's simply trying to recall how do you get cost of equity, how do you get cost of debt, okay? How do you get cost of private share, okay? How do you get the company with average cost of capital, okay? How do you get MCC, okay? Pretty straightforward concepts, I guess, okay? Mosoti, I think we can take a break. Mosoti?
Yes.
We can take a break.
Yeah, 15 minutes.
Okay, so we meet at 7:30.
Yes.
Okay, so fair enough. Then we can meet at 7:30. We begin with a new topic on risk and return. Okay, then we meet at 7:30 then. Okay, welcome back for our second session. Okay, on risk and return. Okay, so for this topic, okay, it's on risk and return. Risk and return. Okay, more or less, I think it's a short topic. Okay, but anyway, you'll see it along the way. Okay, so in this topic on risk and return, okay, we are trying to more or less like attempt to maybe give advice, okay, to potential investors, okay, as to what they should be doing, okay. Should they invest in this particular stock, okay? Should they, okay, dispose a particular stock, okay? Should they maybe, okay, consider it in future, okay, So should we buy? Should we consider it in future, or should we hold our current investment, or should we dispose of current investment? Okay, purely based on the risk and the return we shall be receiving. Okay, from that particular investment. Okay, so that is what we want to assess in this particular topic. Okay, trying to quantify, okay, the amount of risk that the investor shall be exposing themselves to, okay, and of course the amount of potential return they shall be receiving, okay, on that particular investment, on that particular stock that they may have chosen to invest their money in. Okay. Now, what is risk and what is return? Okay, this is where maybe we can begin by trying to define, okay, define in quote what we mean by return and what we mean by risk. Okay. Now, return essentially is the expected, okay, the expected outcomes, okay, the expected maybe this is some cash flows, okay. Now, in case you choose this particular stock, this particular investment, okay, what potential cash flows do you expect to be receiving from that particular investment? Okay, it's about expecting. Okay, it's not about the past. It's about the future. Okay, you can also do the past, but essentially it's more towards the future. Okay, what outcomes? Okay, what cash flows? Okay, do you expect to be receiving from our investment? Okay, over a given time period, over the next 1 year, the next 2 years, the next 6 months. Okay, what return, what cash flows are we going to be receiving from our particular investment? Okay. Simply said, it's going with the return. Okay, of course, about the cash flow. Okay, it's about the return that you will be receiving. Okay, well, of course, we need to quantify in terms of cash. Okay, what's on the other side? What is risk? Okay, now risk is the chance that maybe those cash flows, those return, okay, that we are anticipating to get, we may not get them. Okay, or in case you are anticipating to get 10, okay, maybe 10% or $10, okay, you end up getting 13. Okay, you end up getting 8. Okay. Now, in case you end up getting 13, for example, okay, you are anticipating to get 10, okay, you get 13. Is that risk? Of course, that's a risk also, okay, only from a different angle, okay, is a good risk in quote, okay, because you are receiving more than what you had anticipated, okay. Your anticipation was to get 10, you got 13, okay, something good. But of course, the main concern is the negative side, okay, where you are anticipating to get 10, okay, but you end up getting 8, you end up getting 7, okay. Now that's where now the investor will become concerned. Okay, all the chance that is more towards the negative side. Okay, all the chance that I might end up getting less than what was my anticipated return. Okay, that's the side of the risk. Okay, the chance that the outcomes you're going to be getting, the chance that the outcome you're going to be receiving, okay, is going to deviate from the actual outcome. Okay, the return you are expecting deviates, for example, is different, okay, from the actual outcomes, from the actual returns. Okay, that's kind of the side of the risk. Okay, we just write short notes. Okay, okay. So return. Okay, let's write short note. Okay, is the expected. Okay, the expected cash flows. Okay, the cash flows. Okay, that an investor, will receive. Okay, you receive. Okay, from, let me just call it a stock. Okay, dog, it can be anything. Okay, over a given time period. Okay, over a given time period. Okay, what return do you expect to receive? Okay, what cash flows do you expect to receive over that particular time period? Okay, that's simply what we do refer to as the return. Okay, okay. In case we take a very simple context, okay, if we take, for example, okay, if we take for the case of equity share, okay, for example, in case you are an equity shareholder, in case of equity shareholder, how do we get the return? Okay, the return, I think we already discussed. The return, okay, to be received by the equity share, okay, equity shareholder is given us, okay, P1, okay, minus P0, okay, this is expected, okay, plus the dividend expected all over P naught. Okay, in case, for example, we would want to express the return in percentage. Okay, now what is R here? Okay, and again, this is the expected. Okay, we just call the return. Okay, what do we call it? A better term to refer to is the uncertain. Okay, this is the uncertain. Okay, expected return. Okay, uncertain expected return. Okay, ER of course is the expected return. The expected return. Okay, and P1. Okay, if you remember. Okay, P1. This is also uncertain. The share price ahead of time period. Share price ahead of period. Okay, in case you want to anticipate, you want to assess, okay, what return will I be receiving as a holder in the next 1 year? Okay, so is the share price in a year's time is simply is uncertain. Okay, so that's why this is uncertain share price in 1 year from now. Okay, of course, P naught we already know it, so it's not uncertain. Okay, this is okay share price period beginning. Share price period beginning. Okay, what is the share price beginning of year? Maybe 2020, for example. Okay, then of course D is therefore the uncertain dividend. Okay, for that time period. Okay, the uncertain dividend for that time period. Okay, I think we did this already when we are beginning our syllabus. Okay, we discussed all these things. Okay, this is uncertain. Okay, expected. Okay, dividend for that time period. Okay, for the time period. Okay, this simply is the case of an equity share. Okay, that's the return that the investor, okay, the holder shall be getting over that time period. Okay, P1 minus P naught. Okay, which I think we define it as the capital gain component. Okay, and you have the D, we do a P naught to be the dividend yield component. Okay, but simply as the estimation. Okay, of. Okay, in the case of an equity share, okay, case of an equity share, okay, that's how we do assess the return the holder shall be getting. Okay, we can simplify, and we can simplify. Okay, we say that the return the holder shall be getting, okay, the return that the equity share shall be getting, P1 minus P naught. Okay, this is what we refer to as the capital gain component. Okay, divided by P naught plus the dividend. Okay, anticipated, we divide by P naught. Okay. Let's give therefore the capital gain component. So this is what referred to as the capital gain component, or the capital gain. And here you have the dividend yield. Okay, we have here the dividend yield. Okay, and of course you can express them as percent. Okay, or you can express them as the actual shillings. Okay, the actual cash flows. Okay. And as mentioned, so in case you have to express them, okay, as percentage, like in our case here, okay, we can express these as percentages, okay. Then of course this can therefore refer to as the relative return, okay, the relative return, okay. In case you want to express them, okay, if expressed, okay, in maybe actual returns, okay, express shillings or dollars, okay. This will refer to as the absolute return. Okay, so there's two number of ways you can try to express the return, either as actual cash flows or either as percentages. Okay, but commonly we do use percentages. Okay, I think we already done this, so this is simply a refresher. Okay, so this was the first thing I think we discussed in our first topic. That's in the case of an equity share. Okay, in the case of debt, okay, how do you the return? Okay, in the case of debt, in case of debt holder, the cash will get in is simply the interest. Okay, or in case is gain become, you may have capital gain also. Okay, so you may have the interest, or you may also be getting the. Okay, we can just put a note on it. Okay, okay. In the case of debt holders, okay, in the case of debt holder, okay, the interest or the cash flow, okay, or the return to be received, okay, of course, take the form of the interest. Okay, take the form of the interest. Okay, if this is a marketable instrument, okay, they are debentures, they are bonds, okay, then you may have the capital gain also. Okay, you may have the capital gain component also. Okay, that is in case, for example, the issue you did buy the bond, okay, or you did buy the bond for the company at 100. However, the company redeemed that bond at 105. So you get a capital gain of 5 shillings for the bond, okay? But of course, the bigger component of your return is towards the interest as opposed to the capital gain, okay? The bigger component of return is the interest you receive from the company. Okay? In case of profit share, okay, in the case of profit share, okay, same thing applies just like the case of equity share, okay? There's a preferred dividend to be received. You may, okay, if the private shares as per se, they aren't tradable, okay? So you can trade them, maybe you can try to dispose them off later on. So you may have the capital gain, you may have the capital gain component, okay? But essentially, okay, then it may be there, but not a must, okay? So the case of the capital gain, okay? So you quantify therefore the biggest component of the return you get as a holder will be the preferred dividend, okay, that you'll be getting, okay, every year or every 6 months, okay, whatever the contract you have between yourself and the company, okay. The simplest way of trying to express the return, okay, the return you get as a holder, depending on what instrument are you holding, okay, is it an equity share, is it a debt instrument, okay, is a preferred share, okay, because the return you get, the cash flow getting is different depending on the instrument you do hold as the investor, okay. Now, what's risk? Okay, the simple introduction towards the return. Okay, now what's risk? Okay. Now you see that risk is simply the deviation. Okay, can be referred to as the deviation. Okay, the deviation of the probability. Let me just call it probability. Okay, the probability, or maybe the chance. Okay, that the return we received, that the expected, of course, anticipated return shall differ from the actual return, from the asset actual return, okay, from the asset actual return. Okay, that's what we mean by risk. Okay, simple definition. Okay, the chance that the return that you anticipated, the return that we were expecting, okay, is going to deviate from what you're going to actually be receiving. Okay, and as I mentioned, don't forget, in case you expect to get 10% and you get 13%, okay, that is still a risk. Okay, but on the positive side of it, okay. The main concern is the case you expect to get 10%, but you end up getting 5%. Okay, that's where now the risk, okay, becomes more deal, okay, deal in quote, okay. Yeah, that's simply how maybe you can find what is risk as well as what is return. Okay, what's risk as well as what is return. Okay. Okay, we have assessed here, okay, how we get the return from the individual shareholder, okay. That is simply the capital gain component as well as the case of the dividend yield, okay. That's for the case of the equity shareholder. For the case of the debt holders, okay, simply quantify, okay, the return, the capital gain component, as well as the interest component. Preference share, the same thing, okay, more or less give be the preferred dividend to be received, okay. Now, how do we measure the return? Okay, how do we measure the return? Okay, essentially, the common way of trying to measure the return of a stock is by the use of the mean return. Okay, by the use of the mean return. So let me refer here to what we call the mean return. Okay, mean return. Okay, the R bar. Okay. If, for example, we are anticipating, okay, that maybe in the next 3 or 4 years, okay, that every year these are the potential return we shall be receiving, okay, maybe just a simple example, okay, simple example here, okay, that this will be the return to be received, okay, this is an equity share, expected, okay, equity share return, equity share returns for the next 4 years. For the next 4 years. Okay, this is just a hypothetical case. I'm just trying to construct. Okay, assume that you have 2021, 2022. Okay, 2023, and you have 2024. The return to be received from each of them. Okay, this is the period. Okay, this is the return expected. Okay, in this case, I want to put them in percentages. Okay, so assume here we expect to get 10%, 23%. Okay, and you have 2023 to be, let's say, 17%, and 2024 to be, let's say, 5%. Okay, so see here, yes, 5%. Okay, therefore, the return that we expect to receive, okay, the return that we expect to receive, the mean return, okay, for the next 4 years, the mean return for the next 4 years, therefore, okay, the mean return, okay, the mean return, okay, for the next 4 years, therefore, be equal to, we anticipate to get 10, so 10%, okay, for the next 1 year, plus 23%, okay, plus 17%, plus 5%, okay, but this is for the entire 4 years, okay. Therefore, the mean, we simply divide therefore by 4, because there are 4 years, okay. We still get the 4 together, therefore, the mean return that we anticipate, okay, to receive over the next 4 years per year. Therefore, what is the return to be getting? Okay, and that's simply is how we do get the mean return, okay. And how much do you get, by the way, for this case? Okay, and we get 13.75. Okay, we get that for this example. Therefore, we can say the mean return that we get is equal to 13.75%. Okay, that's the mean return. Okay, which from there, I think we can go to extract the formula. Okay, because therefore the return or the expected return, okay, the expected return, simply just R with that asterisk there on top, is equal to the sum of return, say the sum of return, the individual return from each of the stock, okay, return I, okay, the sum of return I, we divide by 1 over the number of observation, okay, I can call it N, or maybe T, okay. The sum of the return, okay, from the first outcome, okay, let me just export my formula slightly a bit, okay, sum of return, okay, from the first outcome all the way to the nth outcome, okay, of the individual return, okay. So this is I is equal to 1, okay. So here it's not so detailed. So this is I is equal to 1 all the way to the n, all the way to the nth outcome, okay. Just like what you done there, okay. The sum of return we divide by 4, 1 over 4, or get multiplied by a quarter, okay. Simple as that. That's how we do get therefore the mean return, okay. Where maybe just to define n is equal to the number of observation, the number of observations, okay. Of course, this is Ri is the expected return for each of the time period, expected return for period I, okay. Simple as that. That's what we do get therefore the expected return for that particular time period, okay. Simply get the mean return. Now, what if there are not percentages? Okay, what if there are not percentages? Because I'm talking about a case where the company is giving you, okay, share prices. Okay, they're beginning share prices for the next 5 years. Okay, for the next 4 years. Okay, actually, let's use that as an example. Okay, what if the share prices? Okay, if you have to see that, for example, okay, let me just call this example 2. Let me call this example 2. Okay, assume the following The following are the expected share prices and dividends for ABC company for the next 4 years. Next 4 years. Estimate the mean relative return. Okay, so you can have period here. Okay, you can have here share prices, and here you can have dividends. Okay. Okay, period. You can see this is 2020. Okay, share price 2021, 2022, 2023, and 2024. Okay, so the share price at the end of 2020. Okay, this share price at the end of the period. Okay, share price end of the period. Just to clarify on that. Okay, so that period end here, share price period end. For 2020, okay, assume that the share price for this company, the in shillings. So the two are in shillings. Okay, the in shillings. So assume be 20, 2021, you get 29, 2022, you get 28, you get 25, and the share price here 2024 to be, let's say, 32. The dividend for year 2020, assume that here the company doesn't pay the dividend. Okay, so we don't expect it. Okay, so 2021, the dividend, so here there's nothing. Dividend to be equal, let's say, 2.5, 1.5, 2, and let's say 3. Okay. Okay, so those are the potential dividend that this company shall be paying. Okay, for all the way from 2020 to 2024. Okay. Now, in case you ask for this example, okay, your main determine what is going to be therefore the mean rate of return for this share price, okay, for the next 4 years from 2021 all the way to the year 2024. Okay, how do you get that return? Okay, okay, the first step for this case is to quantify the return for each of the years. So the first thing is to quantify the return for each of the year. Don't forget the main to use to determine the mean relative return. Okay, so get the percent return for each of that particular share. Okay. So we can begin by getting the return for the year 2021. Okay, so year 2021. Okay, the return for year 2021. Okay, will be equal to, don't forget the share return is P1 minus P0. Okay, don't forget to remember formula plus D. Okay, we divide by P0. Therefore, the year 2021, okay, the return will be equal to the share price end of the year 2021 is 29 minus the previous year share price, which is 20, that gives the capital gain, plus the dividend for the year 2021, okay, in this case is 2.5, okay, of course we divide by P0, which was 20, okay, that gives the return for the year 2021. For the year 2022, same process, okay, P1 will be 28 minus 29, okay, the previous year share price, plus the dividend for year 2022, okay, which is 1.5, we divide by 29, of course we express as a percent. Okay, for the year 2023, same process, P1, the share price end of the year is 25 minus the share price beginning of the year or end of the previous year, which is 28, plus the dividend for the year, which is equal to 2. We divide by 28, the share price beginning of the year, which is 28. Okay, then for the year 2024, okay, share price end of the year, that's 2, minus share price beginning of the year, which is 25. Okay, plus the dividend for the year, which in this case is equal to 3. We divide by share price beginning of the year, which is 25. Of course, we express as a percent. Therefore, what's the return for the year 2021 in percent? Okay, I'm waiting for your answers. So specify for which year, okay? I'm presupposing that the 57.5 was for the year 2021. Okay, 57.5%, okay? For the next year, that is 2022. Okay, for the year 2022, 1.72%. For the year 2023, for the year 2023, we get negative 3.57%. Okay, that's good. For the year 2024, what do we get? We get 40. Okay, we get 40%. Yes, we get 40%. Okay. Now, having done that, okay, now simply we are going to determine therefore what is therefore the mean, okay, because these are returned for each of the year, but what is the mean return to the investor, okay, or that time period, okay? Therefore, simply therefore the mean return, therefore the mean return therefore to the investor will be equal to the return for the first year, 57.5%, plus the return for the second year, okay, which we got, which is right here, okay, the 1.72%. So plus 1.72% plus return for the third year. This is a negative. Okay, don't forget this is a negative. Therefore, 3.57 is a negative. Okay, plus return for the fourth year, which is equal to 40%. Okay, plus 40%. Okay, and we divide this by the number of observation. Okay, there are 4 years of analysis. Okay, 21, 22, 23, and 24. Okay, so we get 24, and we get the mean return we expect for this particular share for the next 4 years. Now, how much do you get? If you check on your question bank on June 2013, on June 2013, question 3A. June 2013, question 3A. June 2013, question 3A. Okay, so go through it, then we attempt it. Okay, a very straightforward question. June 2013, question 3A. Okay, so in this question, okay, we are being required to get the return for each of the 3 shares. Okay, the return, so Roman 1 is return, okay, Roman 2 is the relative return, okay, which means therefore for Roman 1, then it must be the absolute return, okay, then for Roman 2, it is relative return, okay, Roman 3, we have not done this, so we shall discuss it alone, okay. So Roman 1, the return for each of the stock, okay, for X, okay, for Y, and for Z, okay, okay. Therefore, can be okay by getting the absolute return, okay, for each of the stock, okay. This is for X. For X is simply the capital gain, which is equal to the share price end of the year, which is log as P1 minus P0 plus the dividend. Okay, that's simply given therefore the absolute return for X. Therefore, X to be equal to P1 share price end of the year is 34 minus 30 plus the dividend given, which is equal to 3.4. Okay, and that gives them how many shillings? 6.4, I guess. 7.4. Give us 7.4 for X. Okay, for Y, the same thing. Okay, share price end of the year, 69. Share price beginning of the year, which is 72. Plus the capital gain, plus the dividend given, which in this case is equal to 4.7. To give us how much? 1.2, 1.7, 1.7. Then for Z, okay, same process. It is share price end of the year, end of the period, 146, minus share price beginning of the period, 140, okay, plus the deal given to the year, which is equal to 4.8. Therefore, the absolute return is equal to 6 plus 4.8, 10.8. Okay, that gives therefore the absolute return. Okay, thank you for that. That's for Roman 1. 3 marks. Those are 3 marks for sure. Anyway, Roman 2, okay, we are meant to get the relative return, okay, in percentages in short, okay. For X, okay, log the return is 7.4. We divide by P naught, the share price beginning of the period, okay. So we divide by 30, and of course we express as a percent. For Y, the same thing is total return, okay. We have 1.7. We divide by share price beginning of the period, which is 2. Of course we express as a percent. Okay, then for Z, okay, is a total return, which you got 10.8, okay, divide by P naught, the share price beginning of the period, which is 140. And of course, we express as a percent. For X, what do we get in percent? Okay, for X, we get 24.67%. For Y, we get 2.36%. And for Z, we get 7.71%. Okay, you can see quite 3 marks for there. Okay. Anyway, that says how we get the return. Okay, the both absolute means as well as relative means. Okay, in the case, for example, of an equity share. Okay, I guess we can stop the class there. Okay, and we